Chapter 1. Exposure to valuable information is critical to surviving uncertain times. We live in economically uncertain times. The global economy is crashing. Strong countries and many large global corporations are going bankrupt. It doesn't look like there's a solution for the unending economic downturn. The worst part is that those in the middle and low-income classes are the hardest hit. Many people have absolutely no idea what's going on with the global economy, and many of the economic leaders we look up to for advice and success are confused themselves. How do you conduct yourself in the face of uncertainty? What are the things you can do to ensure things don't go wrong for you and your loved ones? Tony Robbins and his co-author, Peter Mallouk, provide answers to this and other similar questions in your mind and distill those answers in actionable tidbits. The first thing you need to do is calm down. Don't overthink or let fear fill your mind. The last thing you want to do is let fear dictate your financial decisions. Use distracting activities such as your favorite hobby to keep your mind distracted, but while doing that, you want to make sure you feed your mind with the right information. In uncertain times, there is always false information, analyses, and speculations flying around from pundits who either don't know what they're talking about or are intentionally leading ignorant folks astray. You wonder why people consciously feed off your fear and ignorance. Don't give them any more field by blindly swallowing all you read and hear in the media. It's time to listen to objective expert advice. But it isn't easy to get experts to speak cheaply on topics like this. Their advice and strategies are usually disclosed only to a small group of friends and premium clients. Aware of this fact, Tony Robbins decided to take the bull by the horns and use his connections to gain access into the minds of elite financial experts. Unshakeable is a product of 7 years of research and interviews with brilliant men and women in the finance world. If you stay in the market long enough, compounding works its magic, and you end up with a healthy return, even if your timing was hopelessly unlucky. Tony Robbins. Did you know? When any market falls by at least 10% from its peak, it's called a correction. When a market falls by at least 20% from its peak, it's called a bear market. Chapter 2. Mutual funds are not the best way to build a secure financial future. We're smart enough to know that there comes a time when we won't have the energy to work hard for money, so we try to save and invest for retirement. We start this saving early enough, hoping we will accumulate the amount of money we need to keep us going after retirement. Saving for retirement is a wonderful move, but wouldn't it be great if there was a way to ensure you're putting your funds in a place where you'd get the best return? Most people just invest. They don't bother to ensure they're getting the best returns possible. It's a fact that the vast majority is ignorant of what goes on in the finance industry. Research conducted very recently shows that 71% of Americans don't believe they pay anything to have a 401k plan, and from the remaining 29%, only a tiny 8% know exactly how much in fees they are paying for the plan. Ignorance is not bliss when money is involved. You'll pay dearly for not knowing what you ought to know, or at least you will be shortchanged, and nobody likes that. People love to say that knowledge is power, but the truth is that knowledge is only potential power. Tony Robbins. One of the biggest misunderstandings of the financial industry is that investing in mutual funds creates more security and brings more returns. Understandably, many people have this belief. Why? Because mutual funds have active managers, people tasked with beating market returns and bringing you the best returns on your investment, but that's only true in theory. In practice, it's difficult for active managers to find the best stocks to buy and sell. Predicting the market isn't any easier for them as it is for you. When it comes to the stock market, there's minimal experience to offer, so active managers sometimes make mistakes in buying and selling stocks, despite their analysis. And even when they succeed, they will be required to pay transaction fees each time they buy or sell stocks. This expense is one major reason they charge you so much annually, on average 2%. Most people don't see how big this is until they do the math. Let's imagine the stock market gives 7% returns per annum. Over the course of 50 years, you'll get $30 for each dollar because of compound interest. Now, if you're charged 2% yearly, your returns reduce to 5%, meaning you get $10 instead of $30. And that's only 33% of the returns. You invested 100% of the capital, took all the risks, only to settle for 33% returns. Is that something you're ready to accept? At this point, you may be wondering if there are better ways to invest your money for maximum returns. It's a good idea to buy company shares if you can. However, the problem is, shares have skyrocketed in most successful companies. What else can you do? Invest in low-cost index funds. These types of funds don't have active managers, saving you the cost of fees and hidden charges. Be aware that unlike mutual funds that try to beat the market, index funds only attempt to replicate market returns, but they are safer and much more guaranteed. Chapter 3. How to get the best financial advisor. As your net worth increases, you'll realize that you need the help of an advisor to aid in proper financial planning. Most people handle their finances themselves, but getting a professional who knows what they're doing can help you hit your financial goals faster. When looking for an advisor, you don't just go to any firm of your choosing and pick an available consultant. That's a wrong move, considering the nature of the finance industry. If you're not sure what to look for in an advisor, choose a broker who is not out to only enrich himself and his firm. However, finance companies that put themselves before their clients are not wrong. They're only trying to survive the industry. Therefore, your best bet is to find an independent advisor who is obliged by law to put your interest first. Such advisors are liable to be prosecuted if they put their interests first. There are 3 types of financial advisors: brokers, dual registered advisors, and independent advisors. The brokers represent their companies, and it's their job to sell financial products to clients. They're basically salesmen. Just as you know, the job of a salesperson is to make sure you buy what he's offering, even if that product or service is not the best for you. It's best to avoid these people. Dual registered advisors are registered as both fiduciaries and brokers. You should avoid them and only work with pure fiduciaries. How do you determine if someone is a pure fiduciary? Make sure he's independent. Ask to see his professional qualifications. Observe for any trait of salesmanship, i.e., trying to corner you into buying the products he recommends and nothing else. Chapter 4. 4 rules every successful investor obeys. Successful investing is a product of following efficient investment principles. As you know, principles are neutral. If you follow them, you will succeed, and you will fail if you don't. It's as simple as that. Over the course of his 7-year study, Tony Robbins tried to find the common things successful investors on his interview list had in common. As you would imagine, it wasn't easy to figure out because every investor has a unique strategy that works for him or her. But after careful examination, he found 4 core principles that will be outlined in this chapter. Every investor he knew was an ardent proponent of all 4 principles. The 4 vital principles of investing. Avoid losses. Every smart investor will first think of how he can overcome potential losses before putting his money on the line. For someone not acquainted with the money game, small losses may not seem very significant. After all, you can always recover the loss, right? But smart investors understand that you must not carelessly risk even 1 cent. Consider this. If you invested $200,000 and lost 50% of your money, you still wouldn't get your initial capital back even if you had 50% return on the investment. Losing 50% of $200,000 would leave you with $100,000, and a 50% return on that would give you just $150,000, which means losing 50% and gaining 50% in returns wouldn't give you back your original investment. You would need a 100% return for that to happen, and anyone who has been in the markets long enough knows just how hard it is to get 100% returns. Rule number 1, never lose money. Rule number 2, never forget rule number 1, Warren Buffett. Asymmetric risk-reward. Before you invest, you have to be sure the potential gains largely outweigh the possible loss. Don't fall for the maxim that says you need to take great risks to achieve great results. It may work in a different setting, but don't apply it when investing. Just imagine you invest in a high-risk, high-reward venture. It sounds good, but what happens if things don't work out as expected? You lose the huge sum of money you invested. In light of this, make it a rule to only invest when the potential gain largely supersedes the potential loss. For example, if your investment ratio is 5-to-1, that is, you're risking $1 in expectation that you'll make $5, you can feel safe because even if you lost 80% of your investment, you'll still get your capital back. As a rule of thumb, don't risk your money if the investment ratio isn't at least 3-to-1. Tax efficiency. If you're a high-income earner in an industrialized city, your income tax could be as high as 50%. In such situations, you need to find effective ways to legally reduce the percentage of your investment that will be taxed. One thing you can do is sell your investments after at least a year. If you sell them in the same year that you bought them, you'll be required to pay 50% income tax. But investments that run over a year fall into the long-term capital gains tax bracket, which is only 20%. Tax laws vary from territory to territory, so ensure you know the laws governing your area. Diversification. It's risky to put all your eggs into one basket. Find ways to diversify your investments as much as possible. That way, if one crashes, you still have others to fall back on. You can diversify across different asset classes, within asset classes, across markets and countries, as well as across time. No investment is 100% guaranteed. That's why a secure path is investing in a range of portfolios. Chapter 5. Successful investors know they have to avoid confirmation bias at all costs. After successfully trading the markets for a while, your confidence will begin to rise, but you have to be very cautious. Overconfidence has led too many investors into making the wrong decisions. As emphasized earlier, predicting the market is hard for everyone. Don't be tricked into believing that you will always know how the market will turn. I can tell you the secret to happiness in one word: progress. Tony Robbins. Overconfidence can easily make you fall into confirmation bias. Confirmation bias is the tendency to seek out and value only information that confirms your preconceived beliefs. The confirmation bias will make you reject every contrary opinion as negative and incorrect, even when they may actually be correct. To avoid this bias and all its consequences, cultivate the habit of listening to expert opinions contrary to yours. Objectively listen, then judge to see if their angles are acceptable. This habit will help you quickly point out flaws in your judgment and can save you tons of money that you would have otherwise lost. Chapter 6. 2 skills to master for an extraordinary life. Deep in the heart of every single one of us is the desire for an extraordinary life. Of course, extraordinary means different things to different people, but the yearning is all the same. For one person, it's to get married to his high school crush. For another, it could be to live in the house of her dreams, to scale her business, impact more lives, etc. What can we do about the yearnings in our hearts? How can we turn them from desire to reality? There are 2 skills you need to master to make it happen: the science of achievement and the art of fulfillment. You don't need either of the skills, you need both. Let's start with the science of achievement. The science of achievement. This skill will help you achieve your life goals. You can think of it as the external skill since it only focuses on external accomplishments. The second skill is the internal skill. We'll get to it in a bit. To be an achiever, you need the following. Focus. You can't achieve anything worthwhile if your focus isn't on it. Focus helps concentrate your energy on that one particular thing, making you achieve it faster. It's challenging to be an achiever when your energy is not focused. Take massive action. When you're focused, you'll develop the desire, hunger, and deep passion for that particular thing you want to achieve. But you must move from that point to the place of massive action. Your dreams won't become your reality just by wishing they should. It's the action that moves you from dream to reality. Grace. Some call it grace, others call it God or luck or whatever. Just know some things will always be beyond your control, and to reach them, you will need external intervention. Acknowledge the place of grace in your life, and you'll see more of it. The art of fulfillment. You can be the most successful person on earth and still be unfulfilled. Success doesn't guarantee fulfillment, and you must know straight away that success without fulfillment is frustration. Don't let anything come between you and what fulfills you. Unlike success, personal fulfillment is something very intimate. Only you know when you're truly fulfilled, and only you know the things that make you fulfilled. Don't ever attempt to sacrifice your personal fulfillment for success. Don't do it. It's not worth it unless you plan on killing yourself. Aside from doing what you love, there are 2 profound habits that bring personal fulfillment: progress, continuous personal growth, and giving in the little ways you can. Conclusion. The financial market is unpredictable. Don't waste time and energy trying to predict it in the long term, because you will be disappointed. Rather, arm yourself with the skills, strategies, tools, and psychology necessary to thrive in the market. These were discussed in this summary. You might want to reread it again and again to familiarize yourself with the principles. Try this. Success without fulfillment is frustration. Pause for a while and think about how fulfilled you are. Have you sacrificed your joy and happiness just so that other people can be happy? It's best to retrace your steps and put your personal fulfillment above every other thing. Remember the safety instructions they give you when you enter an airplane? In the event of an emergency, put on your oxygen mask before assisting others. In other words, help yourself achieve happiness before trying to help others.